At the start of 2026, a U.S. surprise operation arrested Venezuelan President Maduro, sending immediate shockwaves through global markets and leaving Beijing deeply shocked by what it called an unprecedented attack on a sovereign nation. This wasn't merely a political event. The financial implications for China's massive Latin American investments are now catastrophic, revealing the true cost of this new global power play. But here's the real crisis unfolding behind the headlines. China's deep financial roots in Venezuela spanned decades. Massive Chinese loans financed critical infrastructure and oil exports, solidifying ties since Hugo Chávez's rise in 1999. This was a relationship built on economic dependency. Beijing poured billions into Venezuela's energy sector, over $67 billion since 2007, with 90% of Venezuela's oil exports going to China by late 2025. Just months ago, a Chinese firm inked a $1 billion 20-year deal for oil fields. Protecting these overseas interests is central to China's national security strategy. Now, that financial empire faces direct assault. China has become a top trading partner for almost every Latin American nation since 2000, but Venezuela still owes China over $10 billion in debt. Specific Chinese investment in Venezuela's oil sector totaled $2.1 billion from 2016 to 2023 alone. The Trump administration made its intentions brutally clear. Venezuela must sever all economic ties with China. It must partner exclusively with the U.S. on oil production. Washington believes it can force this. Venezuela's oil tankers are full. The country faces financial collapse within weeks without oil sales. Trump plans to control 30 to 50 million barrels of oil himself. Think about that leverage. Now, to truly grasp the scale of this crisis, we must understand the depth of China's pre-existing financial and strategic commitment. Beijing and Caracas dramatically strengthened their strategic partnership in 2023, well before the U.S. intervention. This wasn't just diplomatic handshake. It was a calculated move to lock in massive investments and secure critical economic ties. China saw Venezuela as an indispensable financial node in its Belt and Road Initiative, a direct challenge to American economic influence in the region. This partnership cemented a vital financial lifeline for Maduro's regime, creating a web of mutual dependency for billions in future trade and resource access. China had become an indispensable financial and political partner for Maduro's Venezuela, a relationship built on mutual strategic interests and billions in capital flow. President Xi Jinping and Maduro met personally to solidify these crucial ties, underscoring the high-level commitment. These weren't mere diplomatic formalities. They were about securing China's long-term access to vital oil and mineral resources, anchoring its energy security. Beijing poured capital into Venezuela, leveraging substantial loans for oil and infrastructure deals, thereby cementing its massive financial stake and strategic influence in the country. This made Venezuela a linchpin in China's global commodity supply chain. The audacity of the U.S. operation becomes even clearer when we look at the terrifying precision of the timing. President Maduro was literally posing for photographs with China's top envoy to Latin America, Qiu Shaoqi, lavishing praise on Beijing's leadership, just hours before U.S. Special Forces began their operation to capture him. This wasn't a slow-burning crisis. It was a sudden, violent rupture. Beijing's deep financial and political commitments, including billions in oil-backed loans and infrastructure projects, were exposed to immediate, unprecedented risk. This sent a chilling message across all Chinese overseas investments. This U.S. military strike on Venezuela isn't just an isolated event. It's a stark redefinition of great power competition. Intelligence analysts are calling it Monroe Doctrine 2.0, a bold reassertion of U.S. primacy in the Western Hemisphere. This doctrine directly targets China's growing financial and political influence in the region, signaling a terrifying new era for global investment and resource access. It means Washington is now willing to deploy overt military force to dismantle economic partnerships it deems adversarial. The financial world must now grapple with this new, aggressive geopolitical reality. This new, aggressive geopolitical reality immediately revealed Washington's true ambitions. It wasn't just about regime change. It was a calculated financial takeover, threatening to reshape global investment and resource control with alarming speed. President Trump wasted no time declaring the United States would run Venezuela following Maduro's capture. This was a direct, unapologetic assertion of control, going far beyond typical diplomatic pressure or humanitarian intervention. Trump even named top White House officials, including Secretary of State Rubio and Secretary of War Hegseth, as the de facto leaders now responsible for Venezuela. This wasn't liberation, it was an administrative takeover of a sovereign state. Such a bold move instantly plunged Venezuela's existing international contracts and substantial foreign investments into profound uncertainty. It starkly highlighted the extreme fragility of sovereign agreements when challenged by overwhelming military and political power. For the financial world, this served as a chilling, unprecedented demonstration of a major power's willingness to unilaterally seize national assets. It fundamentally rewrites the rules for global capital flows and resource security, demanding immediate reevaluation of all emerging market exposure. The underlying motivation for this audacious strategy was undeniably Venezuela's colossal oil reserves. The nation sits on the largest proven crude oil deposits on Earth, an immense strategic asset of staggering financial value. Trump's interest was explicitly driven by this untapped wealth, with a clear stated goal to mobilize these resources for exclusive American benefit. This focus immediately signaled a direct, aggressive play for commanding global energy market leverage, seeking to dictate supply and pricing. It directly impacts future commodity prices, supply stability, and long-term investment strategies for any oil-rich nation, especially those outside the U.S. sphere. For astute financial strategists and energy investors, this was a clear, high-stakes maneuver for complete control over a vital global commodity. This isn't just about oil. It's about weaponizing energy itself as a tool of foreign policy. Washington's terms for Venezuela's future were then delivered with brutal, uncompromising clarity. The White House issued explicit demands. Venezuela must dramatically increase its oil production, but only through an exclusive partnership with the United States. This mandate explicitly barred critical economic partners like China and Russia from any future energy collaboration. It represented a direct, aggressive attempt to dismantle Beijing's extensive financial and strategic investments, along with Moscow's influence, in the region. This policy sought to reroute billions in potential oil revenue, trade, and infrastructure investment exclusively into American channels. It effectively weaponized market access and international partnership, forcing an impossible choice upon any interim Venezuelan authority and sending a stark warning to other nations engaging with U.S. rivals. This was economic warfare, plain and simple, with severe implications for global trade. The U.S. administration further detailed a sweeping plan for Venezuela's oil sales, extending American oversight and control for potentially years after the initial takeover. This was explicitly designed as a long-term strategy, ensuring Washington's grip on the country's primary revenue stream and its economic destiny. Crucially, the U.S. Treasury Department would directly manage all funds generated from these oil sales. This unprecedented level of financial control over a sovereign nation's most valuable resource sent immediate shockwaves through global markets. It fundamentally redefined the risks for all foreign direct investment, especially in resource-rich developing countries, by demonstrating that national assets could be commandeered. This wasn't merely about securing oil. It was about establishing a new, aggressive model of financial subjugation and asset stripping under military threat, setting a dangerous precedent for international law and investment protection. This aggressive takeover wasn't just about American control. It sent a chilling, undeniable signal across the globe, especially to Beijing. For China, the swift, brutal U.S. operation in Venezuela represented a profound miscalculation. Beijing had secured extensive, long-term oil deals, vital for its industrial engine. It poured billions into critical infrastructure projects across the region, cementing its strategic footprint. Yet, Washington's brazen military move caught Chinese leadership by complete surprise. They clearly misjudged the U.S.'s alarming willingness to use overwhelming force for explicit economic ends. This immediately put China's substantial financial and energy interests in direct, grave jeopardy. It revealed a critical vulnerability in their meticulously crafted global investment strategy, one that analysts had warned about for years. The geopolitical landscape shifted dramatically, forcing a harsh new reality upon China's financial architects and commodity traders. The removal of Venezuela's leader, therefore, didn't just reshuffle the deck. It blew up the table in the escalating U.S.-China rivalry. This event handed Washington a new, incredibly powerful strategic advantage in Latin America, a region China saw as key to its global expansion. Beijing now faced a direct, undeniable challenge to its hard-won regional influence, built on decades of strategic lending and trade. This move served as a stark, chilling demonstration of U.S. power projection. It forced China to rapidly reevaluate its entire geopolitical and economic calculus, from energy diversification to debt recovery. The implications for its multi-trillion-dollar Belt and Road Initiative, a cornerstone of its global financial strategy, were immediate and devastating. This was not merely a diplomatic spat. It was a clear, unambiguous escalation of economic and strategic competition, threatening China's entire vision for a multipolar world and its financial security. This wasn't just about political optics. It was about cold, hard, jeopardized cash and long-term asset value. The U.S. intervention created a massive, immediate financial headache for China that reverberated through its state-owned banks. Beijing held significant uncollateralized debt from Venezuela, estimated at over $10 billion. Remember, these were often oil-backed loans, now in question. China's state-owned enterprises also had enormous tangible oil stakes, controlling billions of barrels in Venezuelan reserves. These crucial long-term energy assets, representing massive future revenue, were now directly threatened by Washington's new unilateral control. This jeopardized years of strategic financial planning, putting China's balance sheets, commodity supply chains, and overall energy security at catastrophic risk. The global market was watching every move. The U.S. operation immediately jeopardized Venezuela's established oil flows to China. These consistent flows were a vital, almost irreplaceable component of China's national energy security strategy, especially for its independent refiners. It also put the repayment of vast Chinese debt at severe, perhaps irreversible, risk. Washington's takeover meant China's entire energy strategy faced a sudden, critical, and unprovoked blow to its core. This created immense, paralyzing uncertainty for future commodity agreements and resource-backed loans across the developing world. It fundamentally altered the investment landscape for Chinese firms globally. The message was unmistakable. No investment, no matter how strategic or how far from U.S. shores, was safe from Washington's military and economic coercion. This was a nightmare scenario for Beijing's long-term financial stability and global ambitions. A dangerous, destabilizing new precedent was set for international investment law. But here's the critical twist most analysts are still missing: the true aha moment for global finance and power. The U.S. thought this military operation was a decisive, crushing blow against China's influence. Instead, Beijing immediately turned the tables. The People's Republic of China quickly used the U.S. capture of former Venezuelan President Nicolas Maduro to portray Washington as a hypocritical rogue actor. This wasn't merely diplomatic rhetoric. It was a calculated masterstroke in global public relations. It strategically elevated China's own global image. Beijing positioned itself as a responsible leader of the global South. This narrative is absolutely vital. It cultivates deep trust among developing nations. It secures future financial partnerships, especially for its Belt and Road Initiative. This protects China's long-term investment reputation. It bolsters their credibility on the world stage. Understand this strategic pivot. It's a direct challenge to Western financial norms. This brazen U.S. operation had a far deeper, more concerning ripple effect for international markets and stability. It significantly hardened China's broader geopolitical stance. This wasn't subtle. It was an undeniable shift. Evidence emerged almost immediately in late 2025. Chinese ships were seen patrolling aggressively near Taiwan. This was a clear, chilling signal of Beijing's new resolve. Beijing interpreted the Venezuela action as a stark reminder: raw power and unilateral action now define the global order. For Chinese investors and state-owned enterprises, this translates directly into a heightened focus on national security. It means an accelerated, urgent push for self-reliance. It also demands aggressive strategic asset protection for all overseas ventures. This shift directly impacts global supply chains. It drastically reroutes capital flows. It forces a complete reevaluation of every overseas investment risk. The world is irrevocably changing. Yet, amidst this geopolitical earthquake and direct challenge, China was not abandoning its crucial financial commitments. Beijing quickly affirmed its deep, unwavering commitment to Venezuela. The Chinese ambassador met personally with the new interim leader, Delcy Rodriguez. This demonstrated a pragmatic adaptation to sudden regime change, not a retreat. China sought actively to protect its substantial existing financial stakes in the country. It aimed to safeguard vital future opportunities in the resource-rich nation. This isn't withdrawal from a key partner. its strategic repositioning, and long-term asset management. Beijing will always prioritize its vast investment portfolio. This includes critical oil-backed loans and massive infrastructure projects. Their commitment runs deep, a testament to their long-term financial vision. Leading analysts now recognize Trump's Venezuela raid may not halt China's long-term influence in the region. This is the enduring reality. Beijing is determined to maintain its presence across South America. This includes its multi-trillion-dollar Belt and Road investments, a cornerstone of its global financial strategy. It covers critical mineral projects. It encompasses vast infrastructure development. The U.S. may have seized a leader, but it fundamentally failed to dislodge China's enduring economic footprint. This signals a protracted, high-stakes economic competition for the entire hemisphere. China's patient, strategic approach often aims to outlast short-term Western interventions. Investors globally need to understand this long game. They must anticipate Beijing's remarkable resilience. This is a battle for ultimate financial dominance, and it's far from over. Now let's zoom in on the immediate financial fallout and what it means for your wallet. The U.S. strike on Venezuela didn't just make headlines. It sent shockwaves through global oil markets. Maduro's regime had notoriously bled PDVSA, the state oil company, dry, treating it as a personal cash cow with zero reinvestment. This sudden regime change, therefore, didn't just signal a political shift. It meant massive, immediate implications for worldwide energy prices. Think about your gas bill. Think about your portfolio's energy sector holdings. This was a seismic economic event, a direct hit to the global energy supply chain. This dramatic, unilateral action immediately injected immense, unforeseen risk into the oil market landscape. Major players in big oil, the titans of global energy investment, were forced into an urgent, brutal reality check. They started asking profound, unsettling questions. How would this impact their long-term upstream investment opportunities in Venezuela? The sheer political instability and unpredictable nature of the takeover made any long-term capital commitments look incredibly shaky. This directly affects future global supply projections, the profitability of energy giants, and ultimately, the stability of your own investment strategies. But then, the narrative took a sharp, calculated turn. The U.S. administration began quietly issuing crucial sanctions waivers for Venezuela. This wasn't a retreat. It was a clear, undeniable signal of a deliberate shift in economic policy post-Maduro. These waivers started opening specific, controlled pathways for Venezuelan crude sales. They indicated new, tightly managed opportunities for select commodity traders and financial institutions. This is about Washington actively rerouting billions in global transactions, fundamentally altering established trade flows and investment calculus in a high-stakes play for control. Then came the bombshell announcement from President Trump himself. Venezuela, under its new interim authorities, would turn over an astonishing 30 to 50 million barrels of oil directly to the United States. This isn't just a commodity transaction. It's a colossal strategic asset transfer, a direct claim on another nation's wealth. This single act immediately reshaped global energy supply dynamics. It solidified U.S. control over a critical global resource, with profound implications for international energy security and investment strategy worldwide. What does this unprecedented move mean for the future of resource sovereignty? And more importantly, what do you think this means for the global financial order? So, what's the real bottom line here? This Venezuelan operation fundamentally reorders China's strategic economic presence across Latin America. Beijing's long-term investment strategies and market access in the region are now under direct threat. Remember those billions China poured into infrastructure and energy? This is a massive geopolitical recalibration. It alters the entire financial map for the continent. Now, China's investors across Latin America face an era of profound anxiety. Washington's aggressive moves to assert dominance are forcing a brutal reevaluation of risk. Capital flows will shift dramatically. Project viability is now incredibly shaky. This directly impacts your emerging market investment strategies and global portfolio diversification. The compliance landscape in Venezuela itself is completely unrecognizable. Maduro's removal means international businesses face new, complex legal, security, and logistical nightmares. The cost of operations skyrockets. Old contracts are now worthless. This sets a terrifying precedent for global commerce and cross-border investment. And while the global powers clash, Venezuela braces for a potential economic collapse directly from this U.S. operation. This compounds existing, severe challenges. A humanitarian crisis looms large. This isn't just about oil. It's about a nation teetering on the brink. The ripple effects for regional and global financial stability are catastrophic. The key takeaway is stark. This isn't just a political shift. It's a brutal real-time reordering of global finance and power. When nations openly weaponize their economies and militaries in such a brazen way, what does it mean for your investments? What does it mean for the very future of resource sovereignty? Tell me your thoughts in the comments below.